Picture this. A company just stepped up to the microphone and reported $18 billion in pure profit.
Right.
Like, they shattered absolutely every Wall Street expectation. They are the undeniable beating heart of the global AI revolution. And today, like right now, on April 16th, 2026, investors are frantically hitting the sell button. The stock is falling.
It's the ultimate market contradiction, really. You have flawless fundamentals just colliding head-on with a falling stock price.
Welcome to today's deep dive. We are dissecting the bizarre, almost unbelievable market reaction to Taiwan Semiconductor Manufacturing Company, better known as TSM.
TSM, exactly.
So today they reported record-breaking earnings, yet the stock is actually flashing short-term sell signals. It's trading at $366.54, which is down about 2.33% today.
Yeah, down over 2% on historic earnings day.
Right. So we're asking, is this the start of a falling trend? Is it a classic value trap? Or is the market basically handing you a massively undervalued, strong buy opportunity wrapped up in a red bow?
It's a puzzle. And it has institutional analysts and retail traders completely divided today.
Oh, for sure.
Because the data is pulling in two entirely different directions.
Yeah.
And to understand why, we have to look way past the headlines.
And that is exactly our mission today. We are going to unpack TSM's income statements. We're going to tear into the technical analysis to see who is actually buying and selling on the floor right now.
The order flow is wild today, by the way.
It really is. And we'll also debate the very real downside risks hanging over this stock. Now, as a quick reminder to everyone listening, this deep dive is an exploration of data and natural human debate.
Right, we're analyzing the mechanics of the market.
Exactly. This is not financial advice, but we absolutely want you to weigh in. If you are joining us on YouTube, make sure to like the video, subscribe to our channel, and it is practically mandatory that you leave your feedback in the comments.
We want to know what you think.
Are you buying this dip, or are you staying far, far away?
The comment section is going to be an absolute war zone today.
Oh, without a doubt.
Yeah, which is honestly entirely justified when you look at the sheer scale of the numbers TSM just dropped.
Let's start right there, actually, with the raw financials, because the gravity of this growth is just staggering.
Yeah, let's get into the Q1 numbers.
Okay, so in their Q1 2026 report, net income reached 572.5 billion new Taiwan dollars.
Which is a massive number on its own.
Right, but translated to US dollars, that is $18.1 billion in pure profit in a single quarter.
Yeah.
That represents a 58% year-over-year jump.
And we really need to pause on that figure for a second. A 58% jump in profit for a company of this immense size is, it's almost unheard of.
It's insane.
It's the kind of explosive growth you model for, like a plucky software startup in Silicon Valley, not a heavy manufacturing behemoth that literally serves as the bedrock of global technology.
Exactly. You just don't see heavy industry scale like that. And the top line is just as crazy. Net revenue hit $35.9 billion.
Handily beating their own guidance, right?
Yeah, easily cruising past it. They had set their guidance between 34.6 and 35.8 billion. But here is the number that actually made me do a double take this morning.
Margins.
The margins. TSM reported a gross margin of 66.2%.
It's unbelievable.
Then an operating margin of 58.1%.
Yeah, so to put that 66% gross margin into perspective for you, most hardware manufacturers would practically kill for a 20% margin.
Oh, absolutely, because building physical tech is expensive.
Notoriously expensive.
Okay.
But TSM is achieving essentially software-like margins in a heavy manufacturing industry. It shows that they are practically printing money.
Because they're the only game in town.
Precisely. They are one of the only companies on Earth physically capable of making these high-end chips at this massive scale.
Yeah.
So they have near infinite pricing power right now.
Which brings me to the giant flashing red contradiction on my screen today.
Here we go.
Right. Because TSM's Q2 projections look even better. They are forecasting up to $40.2 billion in revenue for Q2.
The growth is accelerating.
Yeah. Yet today, like I mentioned, the stock is trading down around $366.54. Over the last 52 weeks, the stock has climbed from a low of 145.84 all the way to an all-time high of 390.21 just back in February.
Right, so we're still sitting near historical high.
Exactly. The company just crushed every single metric, guided higher, and the stock is dropping today. It's like acing a wildly difficult final exam, doing the extra credit, and the teacher still docks your grade. Make it make sense.
Well, what's fascinating here is that it really comes down to a classic market mechanism. It's the old buy the rumor, sell the news dynamic.
Okay, unpack that a bit.
You have to remember how a market actually functions, right?
Yeah.
It isn't a report card grading past performance. It is a forward-looking mechanism that is constantly pricing in future expectations.
Right, it's looking 6, 12 months down the road.
Exactly. So when a company like TSM goes on a historic tear from $145 up to $390 in a single year, the market is no longer pricing in like good
Yeah.
performance. It is pricing in absolute operational perfection.
I see what you're saying. So it's like sports betting.
Oh, that's a good way to look at it.
Yeah, like if you bet on a heavyweight champion who is heavily favored to win by a knockout in the very first round, and instead he wins by a judge's decision in the third round.
He still won the fight.
He still won. He's still the champion. But if you bet the spread, you lose your money. The market had already fully priced in the first round knockout.
That is a perfect analogy. When perfection is the baseline expectation, a massive earnings beat isn't actually a surprise to Wall Street. It's just a confirmation of the highly aggressive growth models that everyone already assumed were true.
So the big players are just cashing out.
Yeah. Institutional investors who rode that massive wave up from 145, they look at this perfect report today and say, well, it really can't get much better than this right now. Time to take some chips off the table.
Which triggers the sell-off.
Exactly. It triggers very mechanical, short-term profit taking.
But hold on, I gotta ask. If they beat the high end of their own revenue expectations by that much, the quote-unquote rumor clearly wasn't big enough.
That's a fair point.
Right. How can an institution justify locking in gains when the company just essentially told you they are making billions more than your own analysts modeled for?
Because those massive institutions, they have to balance their portfolios against broader macroeconomic risks, which we will definitely get to later.
Okay, fair enough.
But the selling you are seeing today, it isn't a rejection of TSM's fundamental health. It's a recalibration of capital. It's investors moving money around to manage their own risk profiles after a huge run-up.
Okay, so if Wall Street is just cashing in their winning tickets today, what is actually happening on the trading floor right now? Let's dive into the technical analysis and the order flow, because the charts are telling a very wild story.
The technicals are completely split right now.
Yeah. If we zoom out, the structural bull market is still fully intact. The medium to long-term trend direction is a very clear rising channel.
Yes, but the short term shows serious weakness. I mean, we are bumping up against some incredibly critical support levels right now as we speak.
Specifically, the 50-day moving average, which is currently sitting dangerously close at 366.37.
It's right there.
As a reminder, as we record this, the stock is at 366.54. We are literally pennies away from testing that line. For those following along, why does that 50-day moving average matter so much?
So moving averages, they act as psychological and mechanical floors for traders. The 50-day moving average represents the average price of the stock over the last 50 trading days.
Pretty straightforward.
Right. And when a stock price falls down to that line, technical traders watch it like a hawk. If the price bounces off it, that line acts as a trampoline. It proves there is strong buyer support at that level.
But if it doesn't bounce?
If the price breaks below that 366.37 level, automated trading algorithms and technical traders will see it as a signal that the short-term floor has basically caved in.
Yeah.
And that can trigger a cascade of further selling down to the next support level.
Oh, wow. Meanwhile, the ceiling, the resistance level, is looming overhead right near that all-time high of $387 to $390.
Yeah, that's heavy resistance.
And the momentum indicators underneath all this price action are completely mixed. Like the relative strength index, the RSI, is sitting at 54.83. Can you translate that for us?
Sure. So the RSI measures the speed and change of price movements on a scale from 0 to 100.
Okay.
Usually anything above 70 means a stock is overbought and due for a pullback, and anything under 30 means it's oversold and due for a bounce.
So 54 is...
A reading of 54 is dead neutral. It means neither the buyers nor the sellers have total control of the steering wheel right now.
But then you look at the MACD, the moving average divergence. I know that sounds like a total mouthful.
It's a lot of jargon.
But it essentially tracks whether the short-term momentum of the stock is accelerating faster or slower than the long-term momentum. And the MACD is currently at 2.92.
Which is actually a positive bullish signal.
Exactly. It tells us that beneath the surface level selling today, the underlying current is still pushing upward.
And you can see that tug of war reflected in today's trading volume. By midday today, we've already seen about 14.6 million shares change hands.
That's a lot of volume.
A massive amount. And the bid-ask spread is extremely tight, meaning there are aggressive buyers meeting aggressive sellers at every single penny. This isn't just a sleepy market reacting to news. This is an active, high-stakes battle.
Which begs the question, who are the actual players in this battle? Because the order flow data we're looking at is blowing my mind right now.
This is where it gets really interesting.
We are seeing retail traders panic selling. They see the red day. They see the stock struggling to hold that 50-day moving average, and they get trapped in the emotion of the moment, dumping their shares.
Classic retail trap.
But the insiders, the people who actually build and run the company, they are buying.
That is one of the most revealing data points we have today.
Over the last 3 months, we are tracking net insider buying of roughly $819,000. And we aren't talking about random mid-level managers here.
No, not at all.
The literal CEO, C.C. Wei, and Vice President Borzan Tian have been actively accumulating shares.
And that divergence is just crucial to understand. Retail traders, they are notorious for reacting to short-term price action. They see a 2% drop on an earnings day and assume something must be secretly wrong, right?
Right. They assume the big money knows something they don't.
Exactly. So they hit the panic button to protect their capital. Insiders, however, buy based on forward-looking visibility. When the CEO of the most important manufacturing company on Earth is buying his own stock near all-time highs, it fundamentally implies that he sees long-term value the market hasn't fully digested yet.
Okay, I have to push back here because this is where the logic gets murky for me.
Go for it.
If the CEO is buying and the long-term moving averages scream strong buy, why are retail investors getting spooked out of their positions so easily? Are they just being completely irrational, or is there a valid reason to be terrified of this stock right now?
Well, it isn't necessarily irrational. They just operate on an entirely different time frame and have a different risk profile.
How so?
A retail trader might be worried about paying their mortgage next month or seeing their portfolio dip into the red for the quarter. The CEO is thinking about the company's market dominance in the year 2030.
That makes sense.
Plus, retail investors are heavily influenced by the constant loud debate over valuation. When a stock has run up over 150% from its lows, the fear of buying at the absolute top becomes paralyzing.
Which throws us right into the middle of the loudest debate on Wall Street right now, the valuation. Knowing that retail investors are getting shaken out by the technical dip, we have to debate the core question of this deep dive.
Is it undervalued or is it a trap?
Exactly. At $366 a share, is TSM genuinely an undervalued gem? Or is it a massively expensive value trap?
Well, if you look at Wall Street's reaction today, the professionals are overwhelmingly in the undervalued gem camp.
Yeah, the analyst consensus is practically universally buy or strong buy. In fact, as the stock is dropping today, major firms are rushing out to upgrade their price targets.
It's quite the disconnect.
We've got Needham maintaining their buy rating but raising their price target significantly from $410 up to $480.
Wow.
Barclays just raised their target to $450 with an overweight rating. And Wedbush reiterated their outperform rating, pointing specifically to that insane 66% gross margin we discussed earlier.
Yeah, the analysts are loving the margins.
But, and this is a big but, there is a very real bear case to be made when you step back and look at the company's historical pricing rate.
Oh, absolutely. The bear case, the argument that retail investors are walking into a value trap points straight to the price-to-earnings ratio, specifically the trailing PE.
Let's explain how that works, because this is where a lot of people get tripped up. The trailing PE compares the current stock price to the earnings the company actually made over the last 12 months.
Right, looking backward.
TSM's trailing PE right now sits at 35x. For context, their historical median PE is around 20x. So bears argue, why would I pay $35 for every $1 of earnings today when historically I only had to pay $20? On paper, it looks heavily overvalued.
It does. I mean, a 35x trailing PE in a heavy manufacturing industry usually sets off massive alarm bells.
Yeah.
Normally in hardware, a multiple that high indicates the stock price has run way, way too far ahead of reality and a painful correction is imminent. But, and this is where the bull case fires back, you don't buy a stock for what the company did yesterday. You buy it for what they will do tomorrow.
Which brings us to the forward PE.
Precisely. The forward PE prices in the earnings that Wall Street projects the company will make over the next 12 months. And because TSM is expecting revenue growth of over 30%, the earnings part of that equation gets much, much bigger. When earnings go up, that multiple shrinks. So TSM's forward PE drops down to a highly reasonable 27x.
So you aren't overpaying for yesterday. You're essentially getting a discount on tomorrow. But how can analysts be so confident in that 30% future growth? What protects those future earnings?
What's fascinating here is that that is the exact crux of the bull argument. It's the monopoly toll booth.
The toll booth.
Yeah, a 35x trailing PE is a trap unless the company has an unrivaled monopoly in a hyper-growth sector. We have to talk about their 3-nanometer technology.
The 3-nanometer node, which, according to today's earnings report, now makes up a massive 25% of their total revenue.
It's ramping up incredibly fast.
Now, for the layman listening to this, what does 3-nanometer actually mean?
We are talking about transistors so microscopically small that you literally measure them in atoms.
It's hard to even picture.
It really is. Packing more of these infinitesimally small transistors onto a single chip is what makes modern AI possible. It generates exponentially more computing power while using less energy. And right now, who needs those specific chips?
Nvidia, Apple, basically the biggest tech titans on the planet.
Exactly. This isn't about making generic computer parts. The massive AI infrastructure build-out requires technology that, at this exact moment, only TSM can manufacture reliably at scale.
They are the bottleneck.
They own over 70% of the market share in high-end foundry services. So bulls argue that paying a 27x forward multiple to own the sole toll booth on the highway to the AI revolution isn't a trap at all. It's the bargain of the decade.
Okay, I hear you on the forward PE and the monopoly toll booth. That makes a lot of sense.
You're right.
But a premium valuation, even if it is entirely justified by the AI boom, means the market is pricing in absolute unbroken perfection going forward.
Yes, it leaves no room for error.
And perfection is fragile. If we are going to complete this analysis and figure out why traders are nervous today, we have to flip the coin. We need to look at the downside risk that could shatter that perfection.
We absolutely do.
And honestly, it starts with a $56 billion gamble.
The balance sheet and the capital expenditures. This is where the story shifts from unrivaled dominance to terrifying capital intensity.
Okay, let's unpack this. Let's lay out the raw numbers from the balance sheet today. TSM is a financial fortress. They have total assets sitting at an unbelievable 7.93 trillion new Taiwan dollars.
Massive.
They have a cash position of 2.77 trillion. They're practically swimming in liquidity. But they are spending it faster than almost any entity on Earth.
Their CapEx is staggering.
Their capital expenditure, or CapEx, for 2026 is projected to hit the absolute high end of their guidance range. We are talking 52 to 56 billion US dollars in a single year.
That level of spending is honestly difficult for the human brain to comprehend, and it is the single biggest internal risk factor the company faces.
Why is that?
Because to maintain that 3-nanometer monopoly we just talked about, and to build out the factories for the upcoming 2-nanometer generation, they have to spend a fortune.
Explain to us what that $56 billion is actually buying. Because they aren't just building regular warehouses here.
Not even close. They're buying extreme ultraviolet or EUV lithography machines from ASML that cost hundreds of millions of dollars apiece.
Hundreds of millions for one machine.
Yes. They are building clean rooms that require a level of scientific precision unmatched in human history. I mean, they have to pour concrete foundations so incredibly thick that nearby seismic vibrations won't ruin a microchip during the printing process.
That is wild.
It is the most advanced, expensive manufacturing process ever devised by humanity.
So spending $56 billion in 1 year on equipment, it's like having to build a brand new, massive Fortune 500 company from scratch every 12 months just to keep your crown.
That is the perfect way to phrase it, and that is the vulnerability. Because if there is even a slight macroeconomic slowdown, if the AI hike cools off, say, and Nvidia or Apple suddenly reduce their chip orders by just 10%.
TSM is still on the hook for that massive capital outlay.
Exactly. The depreciation costs on those multi-million-dollar factories will eat into that beautiful 66% gross margin practically overnight.
Blamed if you do, damned if you don't.
Right. If they stop spending, they lose their competitive moat. If they keep spending and the demand drops, their margins collapse.
And that is just the internal operational risk. We haven't even touched the external risk.
The macro environment.
Right. We are looking at this strictly from an analytical standpoint, observing the risks that institutional algorithms are pricing into the stock, but we absolutely have to mention the geopolitics.
The geopolitical reality is deeply embedded in TSM's valuation. We were talking about Taiwan.
Right.
The ongoing geopolitical tensions surrounding the island represent an existential risk factor that institutional investors are constantly weighing.
It's always in the background.
It acts as a permanent anchor on the stock's valuation multiple. No matter how perfect the earnings report is, no matter how high the margins go, that geopolitical risk is always hovering there. And as impartial observers of the market, we have to acknowledge how that caps the multiple.
And it's not just regional politics either. The company is dealing with rising chemical and energy costs directly tied to ongoing conflicts in the Middle East.
Yeah, energy is a huge factor.
You mentioned those massive clean rooms and EUV machines. Semiconductor manufacturing requires an ocean of electricity. Any spike in global energy prices directly impacts TSM's bottom line.
It eats right into the profit.
So when retail traders get spooked today and hit sell, they aren't just reacting to a red ticker. They are looking at this massive web of external risks, geopolitics, energy costs, a potential AI demand slowdown, and wondering if paying a 35x trailing PE is just flying too close to the sun.
Which perfectly explains the market sentiment today. It is overwhelmingly positive, yet deeply cautious.
A weird mix.
Yet investors are rewarding the operational perfection, which is why the stock is still up massively over the past year. But they are highly sensitive to these external macro risks.
So we've walked through the financial juggernaut of the $18 billion profit. We've looked at the technical tug-of-war where insiders are buying while retail is panic selling. We've debated the forward valuation versus the trailing trap. And we've stared down the $56 billion CapEx gamble.
We've covered a lot of ground.
We really have. If we synthesize all of this, what is the ultimate outlook for the listener?
Well, in the short term, the outlook is almost certainly going to be marked by continued choppy volatility.
Makes sense.
The market needs time to digest this massive revenue upgrade against the backdrop of those macroeconomic risks we just talked about. We're going to see a fierce technical battle around that 50-day moving average of 366.37.
Right, that critical floor.
Exactly. If it breaks, we could see deeper short-term correction. If it holds, it confirms the bull thesis and we likely bounce higher.
But the long-term perspective?
The long-term outlook remains highly, highly bullish. We are at an AI inflection point. As long as TSM maintains its iron grip on high-end foundry services, they remain the indispensable linchpin of the entire global technology sector. The temporary selling today doesn't change the underlying physics of their monopoly.
It is a wild contradiction, honestly, a stock falling on a day of historic perfection. But before we wrap up today's deep dive, I want to leave you, the listener, with a final provocative thought.
Let's hear it.
We know TSM's numbers. We know they are the sole toll booth for AI chips. But here's the real question to mull over. Does TSM actually offer better relative value compared to its own primary customers?
Oh, that's an interesting angle.
Think about it. The very companies buying its chips, Nvidia, Apple, AMD, they are trading at their own astronomical premiums right now. If TSM is the company physically building the future, doing the hard, extremely energy-intensive labor that makes AI possible,
Taking on all that $56 billion CapEx risk?
yes, shouldn't its valuation eventually eclipse the companies that are simply designing the chips on paper?
Now, that is a fascinating puzzle to try and solve. If TSM is the engine, why is the steering wheel valued so much higher?
Exactly. Let us know what you think in the comments. Thank you so much for joining us on this deep dive. Remember that opening image. A perfect X-ray of financial health, yet the market sees a break.
Keep an eye on that 50-day moving average.
For sure. Keep questioning the contradictions, don't let the technical jargon scare you off, and keep diving deep. We'll see you next time.